Did Tiff Macklem blow the latest Bank of Canada announcement this past Wednesday? In this video, we're going to chat a little bit about that, but you got to stay tuned to the very end where I give you my predictions on where rates are going to be going. But before we get into this video, please do me a favor and hit that like and subscribe button so other people can find this video. To nobody's surprise, the Bank of Canada left their prime rate unchanged this past week. But did Tiff miss an opportunity to give us some forward direction on where the prime rate will be heading? He definitely did. Was he also a bit misleading? Yeah, he was. So what did he actually say? He said that the Bank of Canada is still prepared to raise rates further if warranted. That is a big load of crap. That is tough talk. That is, do you remember when you were going on a trip with your family and you were being a jerk in the back seat and your mom or your dad turned around and looked at you and said, if you don't smarten up, I'm turning this car around and we're going home. We all knew that was a bluff. And this is exactly what Tiff is doing right now. Tiff doesn't want us to start spending money. He wants to keep the public's expectations that there's still the possibility that we're going to see higher rates if inflation gets out of control. He's saying to the Canadian population, you guys better stop spending money or else I'm going to raise rates further. But load of tough talk, it's not going to happen. Based on our recent economic data, GDP down, unemployment numbers are starting to creep up again. Consumer debt is ballooning. And everyone wonders where this inflation came from. It's coming from consumer debt. And where did all this consumer debt start off from? Take a look at this chart. If we go back to COVID, to just when COVID started, we'll see a trend of how the consumer debt, as rates went lower, increased. This is what's causing the inflation. It's from what the Bank of Canada did back during COVID to drop rates down to pretty much nothing that has contributed to this big run-up in consumer debt. So that's really where this inflation's coming from. And it's going to come to an end because consumers are now finding themselves even more and more strapped. They're not going to be able to access any more credit. And now, based on this new report, we're starting to see people's average credit scores go down. We're starting to see people miss minimum payments. We're seeing balances increase even further. So this can't continue. So once the debt train stops, we're going to start seeing a dramatic drop in inflation. And if you strip out some pieces of the inflation report, if you take out the mortgage interest costs and the rental costs, our inflation is already down to 1.9%. We're actually below the target level for inflation right now. So did Tiff miss the mark in terms of maybe it's time to start talking about rate cuts? When you're driving and you're going 100 kilometers an hour at a brick wall, at what point do you start hitting the brakes? Do you hit the brake once you hit the wall, or do you start braking before you hit the wall? And I think it's time to start tapping the brakes a little bit because the wall is coming, guys. And we tend to overcorrect one way or the other. So it's kind of like when you're cold, and my daughter was cold on the drive to school today. And so I cranked the heat up in the car as hot as possible to get you as warm as possible really quickly. But after a few minutes, it became too hot, and then we had to go the other way. And this is a simplistic version of what the Bank of Canada is trying to do. They're overcorrecting one way way too much, knowing that they're going to have to come down later on. And now we're up to that point where we're going to have to start coming down. And how far are we going to have to come down? And this is what I referenced at the beginning of the video. We're going to have to come down to what's called a neutral rate, where the prime lending rate is not overstimulating the economy or restricting the economy. And I like to call this the Goldilocks rate. Not too hot, not too cold, it's just right. And that prediction of that neutral rate, that Goldilocks rate, is around 2.5% to 3%. Right now, the Bank of Canada's prime lending rate is at 5%. So we have to come down another 2 to 2.5% over the next 1 to 2 years. How fast is that going to happen? I don't know. It could happen rather quickly depending on what plays out over the next 6 months. But like I said, they tend to overcorrect one way or the other. So are we only going to come down 2 to 2.5%? Maybe not. We might end up going even lower. Maybe it's 3% that we end up coming down. So I think Tiff really missed the opportunity this week to inform the Canadian public about where things are going, because he knows we're not raising rates again. The inflation is coming down. Big chunk of it is already embedded with mortgage and shelter costs, which were caused by the Bank of Canada, right? They're like, oh, inflation's up, so we have to raise rates, which causes more inflation, which means we have to keep raising rates. It's like a snake eating its own tail. It's ridiculous. So I don't know why that's even included in the inflation basket. But without that, we're already below the 2%. It's time to start talking about rate cuts, not faking out the Canadian population and letting them know that there might be some more rate increases on the horizon. If you like this video, again, do me a favor and hit that like and subscribe button. If you have any questions, comments, put them down below and I will do my best to answer them as quickly as I can.